Joining me live is Shane Oliver. He is the Chief Economist at AMP Capital. Shane, thanks so much for your time. I think we're all trying to work out where the economy is headed, where interest rates are headed, how inflation is going to come down. What does the latest jobs figures tell us about the health of the economy?
Basically, they're telling us that the economy is pretty healthy. We've got very low unemployment, the lowest since 1974, as we're hearing over and over. We've almost got, I think we've got more job vacancies for unemployed people. So it's a great time to be looking for a job. It's also, though, a bit of a problem to the extent that when you've got a very tight labour market, it does mean upwards pressure on wages, which, of course, we wanted to see for a long time. When inflation is very high, that upwards pressure on wages could become too much and then add to the inflation problem. So that's why it's a bit of a concern for the Reserve Bank. Yes, this is something we wanted, lower unemployment, but it does come with a sting in the tail in that it may add to inflation pressures.
So with wages going up, how much is too much?
Well, that's, I guess, the big question here. There's a lot of debate about that, but my view would be that the optimal number for wages growth would be somewhere between 3.5% to 4%, because that would be consistent with the inflation target being 2 to 3%. Now, of course, in a world when you've got 5% inflation, soon to be 6% and possibly soon to be 7% inflation, then workers would prefer to see a lot more. But the problem if wages goes up to match inflation, as we saw in the 1970s, is that it can lead to a situation where high inflation is permanently locked in, which means ever higher interest rates and ultimately a deeper recession in the economy. So I think the best outcome would be, yes, wages growth goes up, but it gets stuck around 3.5% and inflation then comes back down to somewhere in the 2 to 3% band. That would give workers a real wage increase, but it's not so much of an increase that it causes more inflation.
Shane, when you look at inflation, what industries, if you like, or what aspects of the economy are temporary and what are permanent? What can you see just not coming down at all?
Well, that's a good question, and it partly comes back to how much of this surge in inflation is due to supply and therefore temporary factors that will abate once the pandemic eventually goes through our system and is no longer causing problem, everyone goes back to work, and how much is due to demand. I think there's no doubt that some of those supply bottlenecks are starting to improve. We're seeing declining freight rates around the world. We're seeing declines in order backlogs, pricing pressures, not so much in Australia, but in the US. Upstream price pressures are starting to ease a little bit. Companies are starting to rebuild their inventories. So some of those factors suggest that inflation should start to come down. But you've got these other issues going on, such as the war in Ukraine, which is keeping energy prices high, whether it's petrol, not so much at the moment. Petrol looks like it's coming back down for the time being, but certainly gas and coal. And that's, of course, putting upwards pressure on our energy prices. So there's sort of a bit of a mix in there. Some factors will correct themselves through time, but others won't. And in the meantime, the central bank is left trying to work out which one it will be and has now come to the conclusion, well, we've got to act aggressively. And that's pretty much the same conclusion that not just the Reserve Banks come to, but the Fed, the Bank of Canada, the Reserve Bank New Zealand, other central banks around the world, Philippines, Korea, Chile overnight, they're all getting concerned that inflation is too high and whatever's driving it, if they leave it at these high levels, it's going to be much harder to get back down the track.
It's cold comfort, but we list off all those nations and we do seem to be doing much better even than our near neighbours, New Zealand. We look at the US as well, the biggest economy. How much is Australia inevitably affected by what happens in the United States? Is that kind of the canary in the coal mine for us?
Well, in this case it is. It's not always. Coming out of the GFC, we raised interest rates and the US kept cutting them. And then, of course, around about 2016, 2017, 2018, the US was raising interest rates at a time when we were cutting them. So we don't always follow the US. But at this point in time, our cycles are somewhat in sync. We all got hit globally by the pandemic lockdowns. We all came out of that various speeds. The US was a little bit faster than us initially because it eased its lockdowns earlier. And that means they're probably running about 6 months ahead of us. So our inflation rate, most recently reported to be 5.1%, soon to rise to 6% when the June numbers come out, is below the US inflation rate of 9%. but you don't want to get too comfortable there. I think we probably will stay below where the US is. But what is going on in the US is giving us some guidance that we are going to see higher inflation ahead. There's still more price increases coming through the pipeline. I guess the other concern is that to the extent that the US tightens, US monetary policy becomes tighter, interest rates go up, increasing risk of recession in the US. That does impact Australia because the US is still the world's biggest economy. It obviously affects demand for our commodities, not so much directly, but indirectly, and it also affects confidence in Australia. So what goes on in the US at this point in time in this cycle, I think is critically important for Australia. And if they go into recession, yes, it does add to the risk here.